Here's something most people have no idea is coming. On January 1st, 2027, your tax bill could jump, not because you earned more money, not because Congress passed a new tax hike, but because a law that's been quietly keeping your taxes low is about to expire. The Tax Cuts and Jobs Act, the TCJA, sunsets at the end of 2026. According to the Tax Policy Center, roughly 62% of American households currently pay less in federal income tax because of it. When it expires, the IRS default is a return to the old, higher 2017 brackets. For someone in their 50s with a traditional IRA, a pension, or even just wages, this is not a small shift. It could mean thousands of dollars more in taxes per year, every year, for the rest of your retirement. The window to act is 2025 and 2026. That's it. Today I'm going to show you exactly what changes, who gets hit hardest, and what the right move looks like before this window closes. What the TCJA actually changed. To understand what's expiring, you need to know what the TCJA actually did when it passed in December 2017. This is not just a historical footnote, it's the foundation for every decision we're going to talk about. Before the TCJA, there were 7 tax brackets. After the TCJA, there were still 7 brackets, but the rates dropped. The top rate fell from 39.6% to 37%. The 28% bracket shrank significantly. And critically for this audience, the 25% bracket that used to start at roughly $38,000 of taxable income for a single filer became the 22% bracket. That is a 3 percentage point cut on a wide band of income that a lot of working people in their 50s and early 60s fall squarely into. The TCJA also nearly doubled the standard deduction. For 2025, according to the IRS, the standard deduction is $15,000 for single filers and $30,000 for married couples filing jointly. Before the TCJA, adjusted for inflation, that number was roughly half that. The practical effect was that tens of millions of households stopped itemizing altogether, which simplified tax filing, but also means those households are now fully dependent on that higher standard deduction. If it snaps back, they lose it immediately. The law also capped the state and local tax deduction, what people call the SALT deduction, at $10,000. That's actually a provision many higher income taxpayers in high-tax states want to see expire because the old unlimited SALT deduction benefited them. The SALT cap is complicated, and its fate may differ from the rest of the TCJA, but for most people watching this channel, middle-income households who don't itemize, the standard deduction change is what matters most. All of these provisions were written with a built-in expiration date. Congress used a budget procedure called reconciliation to pass the TCJA with a simple majority in the Senate. Reconciliation rules prohibit legislation from permanently adding to the deficit beyond a 10-year window. So the individual tax cuts were set to expire after 2025, later extended to the end of 2026 under a subsequent legislative process. The corporate tax rate cut, by contrast, was made permanent. Your rate may expire, the corporate rate didn't. Keep that in mind. The bracket snapback. Who pays more? Let's run the actual numbers because the abstract language of rates going up doesn't hit until you see the dollar figure. Under current TCJA rates in 2025, a married couple filing jointly pays 22% on taxable income between $94,300 and $201,050 according to the IRS 2025 tax brackets. If the TCJA expires without replacement, the equivalent income band falls into the 25% bracket under the reinstated 2017 structure, adjusted for inflation. That is a 3 percentage point difference on potentially over $100,000 of income. Let me walk that through end to end for a specific household. Take a married couple, both 58, with $120,000 in combined wages and $20,000 in traditional IRA distributions they're taking early to bridge a gap in income. Their gross income is $140,000. They take the standard deduction, $30,000 in 2025. Their taxable income is $110,000. Under 2025 TCJA rates, the first $23,200 of that taxable income is taxed at 10%. The next $71,100 up to $94,300 is taxed at 12%. The remaining $15,700 is taxed at 22%. Their approximate federal tax bill is around $16,300. Now run the same income through the post-sunset structure. The standard deduction drops. Estimates from the Congressional Budget Office suggest it could fall to roughly $16,000 for married filers in 2027 after inflation adjustments, compared to the TCJA level. So their taxable income jumps from $110,000 to approximately $124,000. The bracket rates shift upward. That same household now owes closer to $21,500 in federal taxes, a difference of more than $5,000 per year, every year. That's not a rounding error. That's a car payment. That's a year of groceries. That's real money. And this is the median-ish scenario. If your income is higher, or if you're drawing down a large traditional IRA, or if you're receiving Social Security that becomes partially taxable because your provisional income rises, the math gets worse. Your situation varies depending on your filing status, your income sources, and your state tax picture, but the directional answer is the same for almost everyone in this audience. Taxes go up in 2027 if Congress does nothing. The Roth conversion window, and why right now is the right move. Here's where this becomes actionable.
If you have money sitting in a traditional IRA or a 401k that hasn't been taxed yet, every dollar you convert to a Roth before the end of 2026 gets converted at today's lower rates. After 2026, converting that same dollar costs more. That gap is locked in permanently for every dollar you convert now versus waiting. Roth IRAs have no required minimum distributions. According to the IRS, traditional IRAs require you to begin taking RMDs at age 73 under Secure 2.0, and those distributions are taxable. A Roth has no such requirement during your lifetime. Every dollar you leave in a traditional IRA will eventually be forced out and taxed, possibly at higher post-sunset rates, possibly when your Social Security is also being counted as income, possibly when a surviving spouse is filing single at higher rates. The Roth conversion window isn't just about avoiding the cliff, it's about redirecting future tax liability away from your retirement years entirely. My take is clear. If you're in the 22% bracket today and you have room to convert without jumping into the 24% bracket, convert now. The right move is to fill your current bracket, not exceed it, with Roth conversions in 2025 and 2026. Here's what that looks like in practice. Take a single filer, age 61, with $60,000 in Social Security plus wages income. The 22% bracket for single filers in 2025 runs from $47,150 to $100,525, according to the IRS. After the standard deduction of $15,000, this person has taxable income of $45,000. They're sitting near the top of the 12% bracket. They have room to convert roughly $35,000 from a traditional IRA to a Roth and stay entirely within the 22% bracket. After 2026, that same conversion likely crosses into a higher bracket because the bracket thresholds shift down and the standard deduction shrinks. The conversion isn't free, they pay tax now, but they're paying at 22% instead of 25% or higher. On $35,000, that's a $1,050 difference. Do that for 2 years, 2025 and 2026, and you've moved $70,000 into a tax-free Roth at a $2,100 savings over doing it later. The math is not subtle. One edge case that trips people up: Social Security taxation. If you're already collecting Social Security and you do a large Roth conversion, you may push your provisional income above the 85% inclusion threshold. According to the SSA, up to 85% of your Social Security benefit becomes taxable if your combined income exceeds $34,000 for single filers or $44,000 for married couples. A Roth conversion counts toward that combined income calculation, so a big conversion could simultaneously trigger more Social Security taxation in the same year. The right approach is to model the full picture, not just the bracket math, before converting. This is exactly why working with a fee-only fiduciary matters here. The direction is still right, the sizing requires precision. The estate and gift tax cliff. This section applies to fewer people watching this channel, but it trips up more people than you'd expect, especially those who have built equity in a home, a small business, or a rental property over decades. The TCJA doubled the federal estate and gift tax exemption. For 2025, that exemption is $13.99 million per individual, or nearly $28 million for a married couple. If the TCJA sunsets without replacement, that exemption roughly halves. The IRS has projected the post-sunset exemption, adjusted for inflation, would fall to approximately $7 million per individual by 2020. If you're thinking, that's not me, pause for a second. The median home price in the United States, according to the National Association of Realtors, hit $407,200 in early 2025. Add a 401k, a life insurance policy, and a small business or rental property, and some households in their 60s are closer to estate tax territory than they realize, especially if they live in a high-cost metro area. If you're anywhere near the $7 million threshold, the right move is to talk to an estate attorney before 2027. Annual gift exclusions, currently $19,000 per recipient in 2025 according to the IRS, are a tool that doesn't require you to give up control of assets immediately. Using them now is worth understanding. What most people get wrong about the sunset. Here's the most common misconception I see about the TCJA cliff, and it costs people real money. Most people assume Congress will just extend the TCJA and nothing will change. That is possible. There is active legislative discussion as of 2025 about extending some or all of the individual provisions. But here's what's almost certainly true. Even if Congress acts, any extension will likely be partial, phased, or tied to offsetting revenue measures somewhere else. The full, clean, permanent extension of every individual TCJA provision is the least likely outcome because it's the most expensive. The Congressional Budget Office estimates that a full permanent extension of the expiring TCJA provisions would add approximately $4.60 trillion to the federal deficit over 10 years. That is a number Congress has to account for. Some version of change is coming. The second misconception is that you can wait until late 2026 to decide. You can't. Roth conversions take time to plan correctly. You need to know your income for the full year before you can size a conversion without overshooting a bracket. Most people who do Roth conversions strategically do them in the fourth quarter after they have a clearer picture of their annual income, but the planning should start now. If you wait until November 2026 to think about this, you will likely either undershoot the opportunity or worse, overshoot and pay a higher rate on the conversion itself. Start modeling now. Do the conversion in Q4 2025, repeat in Q4 2026. The math is not subtle. One more thing people get wrong. They conflate Roth IRA contribution limits with Roth conversion limits. There are no limits on how much you can convert from a traditional IRA to a Roth in a given year. According to the IRS, you can convert any amount. The constraint is tax, not a contribution cap. The annual contribution limit for a Roth IRA in 2025 is $7,000 if you're under 50, or $8,000 if you're 50 or older for the IRS, but conversions are entirely separate. You could convert $50,000 or $200,000 in a single year if your tax situation supports it. The limit is your bracket math, not an IRS cap on the conversion itself. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this video helped you see the 2026 window more clearly, hit subscribe. We publish retirement planning content specifically for people who are starting late and want straight answers, not generic advice. Drop a comment below with the retirement or tax topic you'd most like me to dig into next. I read every comment and build upcoming videos directly from what you're asking. Next week, we're looking at a rule that catches a lot of 62-year-olds completely off guard. If you're planning to work part-time and collect Social Security at the same time, there's an earnings limit of $24,480 in 2026, and exceeding it means the SSA temporarily withholds part of your benefit. That's coming up next, and it's worth understanding before you make that decision. See you then.